IVM.
Folks, welcome to a brand new episode of the Ideas Project, a limited series by Smallcase. I'm your host Anupam Gupta, and today we are joined by two guests, Priyank Shah and Mangalam Maloo. Priyank is the founder of Beardo and of Renee Cosmetics, one of India's biggest men's grooming product brands, and Mangalam is an accomplished assistant editor and anchor at CNBC TV 18. Priyank has helped Beardo reach a very strong place in the marketplace where it is widely recognized. Their products are considered to be some of the best in their category, and in 2020, they got acquired by Marico, allowing them to scale up further in multiple avenues. At CNBC TV 18, Mangalam covers all things consumer, FMCG, retail, QSRs, building products, and the logistics sector. All of this makes both of them, Priyank and Mangalam, the perfect folks to get on this episode, where I want to talk about how D2C businesses are giving competition to huge FMCG giants and where we will see these markets going in the near future. All of that coming up right after this short break.
We face 100 dilemmas every day while raising our children and nurturing our families. Why not let science help us make informed decisions to solve our dilemmas? Hi, I'm Devi Shobha.
And I'm Meghna. We host Big Talk About Tiny Humans, where we will help you unpack challenges around parenting and your child's development.
And more importantly, we will equip you with research-backed strategies that you can readily act on.
Tune in to our podcast every Wednesday on the IBM Podcasts app, website, or your favorite podcast platforms.
And welcome back. Welcome to the show, Priyank, and welcome to the show, Mangalam. How are you guys doing here?
Doing well. Thank you, Anupam. It's fun to be speaking to you and Priyank as well. Good to meet you.
Likewise, guys. Thanks, Anupam, for having us, and obviously a great co-star to have with.
Well, not a co-star, I would say. I'm just a sideshow. You're the star here because we've been tracking Beardo from its pre-Marico days. And ever since it's been acquired by Marico, what a different trajectory it's been on. I think this year itself, they have a huge target for it.
Super. Actually, when we see that what we've been doing with Beardo and now when it's been with Marico, it's been doing super wonderful. And that was the overall scenario for why this M&A at first place, because we being prematures or amateurs at a level, we came up with an idea and we knew that we can scale it to a level. But whenever you want to grow, it is very important to believe in the people who have done it already, and who better than Marico. Mr. Harsh himself and plus the team that they have, it was super wonderful to work with them.
The only thing I can say is that while I can admire your business from the outside, unfortunately I can't use any of your products because I don't have a beard.
I think we are more than beard company anymore now. So I think we do have a lot of list of products like grooming. We do have waxes, face washes and gels, and all of that makes a complete men's grooming brand. Beard obviously was the pain point that we wanted to jump up with, because just did not wanted to have face wash brand or a shampoo brand. My face wash is better than yours and all of it. That was not the game. We wanted to identify the problem, and that was beard. And what macho than a beard is what we identified, and then moving forward we went with the Beardo as a brand name and then established as a whole men's grooming brand.
Fantastic, folks. That is a background to Beardo. Priyank, let's start with you. What do you think of the new D2C businesses that are coming up that have learned how to capitalize on the power of the internet?
So internet, what we feel is the powerful tool to educate. I will not directly jump up to sales. I would like to understand, or maybe like to explain this, that internet has been a super powerful tool for all of us in terms of D2C businesses, which have helped us to evaluate and explain what we are in terms of the overall genre. Say for instance, traditional businesses versus D2C businesses. It was so tough. If you go 10 years back, it was so tough to even educate your customers. There were only few ideas. Either you can go do TV, either you can do billboards, or you can do in cinema ads. That were the only forms of advertisements. Now when you jump to 2020, 22, all of this 4-5 years have been really great in terms of campaigning, educating. If I have an idea, I can come up with a very beautiful way of explaining to my set of consumers in a very limited time frame, and I can map and evaluate it. Say for instance, I did a campaign on TV or maybe on any TV ads or anything. I'll not be able to monitor what kind of sales is it fetching, or maybe how many eyeballs did I get. Yes, there is a ballpark figure of understanding ke itna TRP, this and that. say for instance, you cannot directly map what are the kind of eyeballs you got. When we jump to internet, you can directly understand that this is the kind of eyeballs that you've gotten from this particular campaign. A beautiful part of it is which we call to action. In D2C brands, there is a beautiful term called call to action, wherein you can directly measure that this campaign has given you this kind of sales and this kind of visibility, which traditionally was not available. So I feel that it has empowered a lot many things. Lately, in terms of categories, have expanded a lot. Initially, finding a transport was a tough task. After all these new age brands, finding a transportation, a commute has been easy. Finding stay have been easy. Payment methods have been easy. So I would feel that it's a very powerful tool.
Okay, if we look at the investment side of the business now, how has D2C as a sector been? Okay, in terms of investment opportunities so far, and do you think how this is going to change going forward?
So D2C, it's obviously, I will primarily feel it's a great way to do it. But apart from it, last year, it has been really tough for all of us in terms of the ad spends and all. So we can see that Facebook and Google's have been the only one who's making money out of this. But again, making also on the brighter side of it, they can give you direct consumers, which traditionally is not possible. So in terms of your investment opportunities in this kind of businesses, it's true to have that, and it's true to be good having a D2C brand rather than just having a traditional form of businesses wherein you can get a reach, like you can reach out to your consumers directly in a way wherein, say, you have a product idea. You only have a very niche category of consumer that you want to tap, which is practically possible with this segment, which is not practically possible with any traditional methods. So I feel it's a very good investment opportunity.
Sure.
On the other side of it, if we try and understand that the level of spends that you are doing on D2C versus traditional methods, D2C is going to be more fruitful. You might end up spending little more on the first time, but you're going to get repeats out of it, and which you can track, which I feel is best thing to have rather than being on the dark side of it wherein you don't know who's buying or who's watching your ad. So I feel it's a good way to do it.
Sure. Mangalam, FMCG stocks, big. So if you look at it from the FMCG brands that are listed, how have they been traditionally for investors?
They've been very, very good over the long term. I mean, investment into the FMCG space, and I say this not as a champion for the sector, but just as an outside analyst, it depends on the period that you're looking to invest in the company for. There might be long periods of underperformance, as in between 2003 and 2010, say for instance, when the market boomed, HUL did practically nothing. But over the last 10 years, the stock has moved almost 10 times. I was looking at some data. Asian Paints itself over the last 10 years moved almost 10 times, and this after having moved 10 times in the previous decade. So it's not a 20-time move, it's a 10 into 10, 100-time move. Pidilite, a big wealth creator out there as well. So whatever company you look at, Britannia as well, for instance, in the last 7-8 years has moved around 700% or 7 times. And this is, notwithstanding the sort of weakness that we've seen over the last couple of years. So depending on the investment horizon that you have, from a long-term standpoint, you're usually better off in the FMCG space than any other space, risk reward adjusted. And that's primarily because of a couple of things. The first thing is that the Indian demographic is such that India is the only country in the world where, you don't need to generate demand. Demand's already there. Just get the right product at the right place to the right audience and promote it well, the 4 P's of marketing that they say, and chances are that you will be successful. Secondly, FMCG companies, if the brands are well known, then from a business standpoint, you don't need to invest in capacity building. You can license that out. So your investment in the business remains low, but because of your brand visibility, your returns are high. So that's high ROCE, high ROEs if you must. And the third thing is that if you're not spending much on capex, your brands are doing well, your returns are high, you will start generating dividends. So you will keep a lot of dividends for all the investors. And finally, what is the big bane of all the listed companies? It is, promoter integrity, management quality. In the FMCG sector in particular, I would say, it's the cleanest shirt in the laundry. If you just look at the kind of pedigree of managements that you have, both multinational as well as domestic, both professional as well as family-owned companies. So you have all the right boxes that the FMCG sector ticks. The only thing you need, patience and entering at the right time.
Right. Going forward, impact of inflation. on FMCG?
Going forward, well, it is extremely uncertain right now. But if backward is something to look at, the last 4 or 5 quarters have been, a cyclical rise that we've seen in all the input prices. I mean, I was just looking at some data. Over 100% rise is what we've seen in some of the key inputs for, making soaps, as well as some of the food snacks you need, palm oil, PFAD, derivatives, etc. They've risen by almost 65%. And for your inputs to rise by that amount, it's painful. We've seen over 250 to 300 basis points in terms of margin correction for all the companies that have reported their numbers so far. And these are big companies that I'm talking about. It's the HULs of the world. You have Nestle and Britannia that reported its numbers just a couple of days ago. So these are companies which can, somehow mitigate the inflation impact by either passing the prices on to consumers or taking the hit on the EBITDA margin as well. But it's not a good sign to see input costs increasing so much.
Yeah. Priyank, talking about the pandemic, how has that changed the focus of FMCG towards D2C?
I think the cost of doing business for all of these giants is super high. When we talk about distribution channel, also we talk about from production module to having the product on shelf, there's a lot of other costs that a traditional FMCG company has to derive when it to at least reach out to a consumer, which is too expensive for them. Where in D2C, it is directly going to the consumers. You cut down on a lot of costs. You don't have to maybe give your margins to distributors, to your retailers. There is no other cost which is associated to sell the product. So a lot of companies do feel that now it is the correct way of doing it. Yes, vis-a-vis, there are a lot of other expenses to also reach out to the consumers, because to finding a right set of consumer is also tough, which takes a lot of efforts, campaigning, marketing, branding, all of it. But in and all, what I feel is that, post-pandemic, because of cost cutting, obviously, these are the primary cost cutting ways of maybe, having the retailers out of the bucket who are not doing much volume, maybe distributors or the regions who are not doing volumes. The fundamental is same. Everyone wants to reach out to the consumer directly, but when you can do it via D2C, then why to have a traditional measure of doing it? So I feel that a lot of giants have turned up with this kind of module, because it helps them to reach out to the correct set of audience with correct amount of money spent. So that is how I see.
Same question to you, Mangalam. Why are we seeing a shift towards D2C by the FMCG brands?
The way to look at it is, that D2C is basically nothing but a microcosm of the way the world has been. At every point in time of the world's evolution, participants, human beings have tried to eliminate the middle element. And I'm not saying the middleman, the middle woman, the middle element itself. So the internet is the biggest example of that. You eliminate distance, you eliminate time, you eliminate the need for physical space. And D2C is just a logical extension towards that. Every time why is it that if I have to buy a product, I have to go ahead and wait for the entire distribution channel for the product to be available in stores for me? Why is it that, I have to look for a big institution, a brand, to go ahead and do the consumer survey and basis their research, etc., they launch a product that may be required for me? What the internet does actually is it removes it consolidates the market in a way that long tail products or products which are for a very niche group of people are big enough. The niche group of people come together in a consolidated way, and that makes sense for the product to sell on the internet. Let me give this to you as an example. There would not be more than 100, 150 people. This is just an example in a particular area which would want a specific product for a very niche purpose, say beard grooming. You won't find more than 100, 200 people in a building block. So it won't make sense for a chemist to store niche products in their shop. But if you just look at it from an internet standpoint, all of them come together. There could be 100 people in a particular building. There could be 100 people in a building, say 10 kilometers away. There could be another 100 people in a city, say 100 kilometers away. So all of them will consolidate and come together on the internet, and that makes doing business viable. And that's why D2C as a concept was, thought of, if you think of it like that. And that's why it's seen the success that it has.
Okay, so I have a question for both of you. Mangalam, since you're there, I'll start with you. What advantages do these new age brands have as compared to the FMCG giants? Just picking up from your previous answer.
The biggest advantage is that they are faster to the market than the FMCG giants. Secondly, they can get into long tail products. Long tail products are extremely niche products which could do, say 5 crore revenue, 10 crore revenue, 15 crore revenue, which in the larger scheme of things for an FMCG company which does 100,000 crore revenue will, not even look at it. They'll say, okay, the market's too small for us to actually put our minds to it. Once the proof of concept is made by these brands, only then will we go ahead. That is when it makes sense for us to invest behind a certain category. So that is the biggest advantage. The second one that D2C players have against the FMCG guys is that they speak directly to the consumer. The traditional FMCG companies have to speak to multiple stakeholders. You have to speak to the distributor, you have to speak to the wholesaler, you have to speak to the end retailer and give them margins, and then eventually speak to the consumer. So the direct consumer connect that you want to establish does not happen in a way that a D2C company can do. The third most important thing that the internet has done is that, in the world of Web 1, you had the companies speak to the consumers, and that was one-way communication. In Web 2.0, you had companies speak to consumers, companies reply back to consumers on all the social media platforms, etc. And now the world that we're moving into, the opportunity lies in consumers of a certain product building communities within themselves. And that itself becomes a large independent entity where you can then go into the why of a brand rather than a what of a brand. So once they buy why of a brand, they'll go ahead and buy whatever of that brand.
Interesting. Priyank, same question to you. What advantages do the new age companies
have
over?
I do look at that two ways. So one is the appetite to experiment. So all these new age D2C brands have a lot of appetite to experiment on a lot of many things when it comes to a product offering or a service offering. They do not have anything to lose out on at this point of time. So they'll try and work out with a way which is trying to resolve a lot many problems. So they'll reverse engineer it, work in with a way wherein they'll figure out a problem and then they'll provide a solution. So that's how this all D2C brands have been working on to get on their products get on consumers on board. So that's how they've been working, and which is the established brand cannot do it, because they will come with a lot of data understanding. They'll want to understand the past records and how the overall trend line have been, and then they'll want to jump up in a service or a product offering, which is very good, or maybe it serves sometime well for the D2C brands, or would be a success or a failure, cannot comment. But that's how part A of it has been. Part 2 is cost of failure. There's nothing to lose for all these new age brands or maybe D2C brands. I'm not going to lose out on anything. I can keep on experimenting. I can try on offering new products. I can understand my consumer well, and then I can come up with an offering which I do not have to work out much. I can keep on trying and trying and trying, wherein all these other huge giants are going to come up with a lot of other data. So what I feel is that all these D2C brands are futuristic, wherein the giants are based out on the past data. So if you want to grow, think out of the box. It's obviously well to see the future about it, rather than what's happened in the past is in the past. You cannot see the records, scratch the records and try and come up with a product, because it was for past. Today, if you want to grow, I think understanding the future is what these guys have scratched the surface and got that one good factor for them, that okay, let's understand what's been needed in the future. Let's work on it. We might fail. Obviously, the risk of what we say failure is high there, but that's okay. Yeah. There's nothing to lose though.
Just to add to what Priyank is saying, D2C brands actually have, or rather, they don't have the worry of a legacy brand which is standing. So they can absolutely go ahead and experiment. And whereas the other thing is that in terms of positioning, they're starting off with a clean slate. So they can create whatever they want to, as against say an HUL wanting to, cater to an extremely niche, very premium sort of customer. There will be some sort of legacy costs and legacy notions behind them for them to go ahead.
Sure, Mangalam. Can D2C brands ease the burden of the consumer, and if so, how?
Depends on what the burden is, because if you're talking about the burden of going to a store, looking for a product, scrummaging through shelves and then waiting at queues, yes, it can most definitely is the burden. If the burden that you're talking about is, catering specifically to that very need that you have, then most definitely it can ease, because not every company has everything that you need. And if you're talking about the burden of the product being of great quality, or the concern about quality, a lot of the D2C brands actually do focus on clean labels, good quality ingredients, and that's how they build the communities around them. So those are the burdens that D2C brands can ease for the customers. What is it that they can't ease, and what is it that legacy players have? One, cost efficiencies. So, it will be difficult for I'm not casting any aspersion on a brand. So it's difficult for Mama Earth to supply at a price in which HUL sells.
Sure. True. Priyank, they say that the Indian consumer is the most spoilt consumer in a way. They want everything fast, everything cheap. And plus they want a discount on top of that as well. Do you believe this is, in your experience, do you think this is true? And how have new age D2C companies taken advantage of this knowledge?
I do contradict this statement in terms of spoiled. Yes, Indian consumers are very well aware of what to buy, when to buy, what to spend. So that is absolutely at par. I'll give it up to Indian consumers on that front. Yes, but I think all these pizzas guys delivering product in 30 minutes, or maybe all these other delivery giants who've been trying to deliver products in 10 minutes, that have obviously spoiled the mindset of the consumers that everything that you want is right now. So it's a good thing to have, maybe a sad thing to have, because certain things obviously take time to, like if you want to cook food, obviously it's going to take some time to cook food. But yeah, it's a good thing to have. Competitiveness has to be there in the market to make sure that things are live and kicking. I'll feel that it is an advantage to a lot of many things, because that's how the overall D2C thing would work. People would want to come up with new offerings every time. People would want to come up with new ways of doing certain things, which was traditionally not the way. A lot of niche products we've seen in terms of laundry servicing, or maybe ride kind of apps and all of it, which is really boon to the industry, is what I feel.
Okay. What is the power of a well thought out D2C business in today's world where everything is so connected?
Again, getting to the spot where we talk about internet, it is beautiful to have a lot of things on hand at this point of time. Lately, if I go back and understand payments as an issue, a lot of things wherein you have to stand in a long queue to get your payment deposited or get credited, whatsoever it was. Maybe again, certain points of transportation and all of it. So the Indian consumers, there was a lot of opportunity is what we feel in India it is, because still the surface have not been scratched. So if you talk about any other areas of development, it is much needed that internet can go deep and come up with a lot of solutions which would make life easy. You can see on that front that whenever we are talking about making or giving up some services which would make life easy, that is at par going to be acceptable from all of these other people. Like Jio coming up with their module and maybe reaching out to 400 plus million Indian consumers is really well. The service offering would be anything, though it would be just internet or just anything other else. But it is good. Like if you even try and work out on the entertainment front of it, a lot of things have been developed really well. A lot of content have been really easy for an Indian consumer to watch. Again, in terms of the services, if you talk about your transport services, your payment banking services, or product offering as a services, it's absolutely boon to Indian consumers.
Okay, so I have a question again for both of you. Priyank, I'll start with you. How can D2C businesses in this FMCG space specifically, how can these brands make sure that they continue growing and not stagnate or hit a ceiling?
Now, again, getting back to the numbers, if you see that, yes, we do have a lot of people who have device on their hand, but they have not started using services. Again, if you see that Indian consumers who are buying products on internet is somewhere around 7.5%. If you compare with US markets, it's somewhere around 48 to 52%. So that's a lot. We still have a huge way to cross. So there's a lot of opportunity for this kind of products offering in the market. And I think it has just started. We've not even reached at a level wherein we can, talk about hitting the ceiling kind of thing. But I absolutely foresee that this is gonna be next big thing. You can directly speak to your consumers. What better than that? You can sell to your consumers, speak to consumers. You can understand them really well, which we were not able to get that before, like all of this 10 years back. Now it's all easy. Yeah. So I think people are working well towards it, and companies can grow really well if they look on the brighter side of it, or maybe trying to understand the education side of it and technology side of it, then there's a huge scope.
Okay. Your thoughts, Mangalam? Same question.
Well, there are three ways in which a D2C company can grow. The first one, of course, is that, it moves away from the online and goes into the offline model as well. And for all these three ways, there are merits. Being an online first brand, you've established proof of concept. People know that there is a need for this product. So from being an early adopter, long tail sort of product, you now go into the mass market, and that is the one way you can grow. The second one is that now you know that this is the niche of the product, and it's been exploited completely. But what you've also learned is that this is how you seed a product into the market, and this is how you grow a product. So then you start repeating the same, and then you create a sort of house of brands. I mean, for example, again, Mama Earth recently bought Be Blunt as well, because they would have their experience of creating a good brand in Mama Earth. So they'll replicate that model by having another brand. So that's the second way. The third way to do so is that when your brand itself, the ethos of the brand itself has been communicated well enough to the consumer, and that has been accepted by the consumer, then you can get into newer categories. I mean, Priyank started by saying that, he wanted to get into the macho category, beard category of men's grooming. And once you tap the beard, people now know that it's men's grooming. It's not limited only to the beard. Then you have other products that you add to your mix as well. So three ways. Once you change the channel from online, you go into offline as well. Secondly, you change the number of brands that you've added, replicate the same model. And the third one is you add new categories. So those are the ways you can mitigate this growth ceiling, so to say.
Okay, Priyank, let's look at this in a way that what are the differences, right, between traditional FMCG companies going D2C and D2C first companies going offline, right? What are the advantages that the traditional FMCG businesses can enjoy by doing this, and what advantages would D2C first companies have in this regard?
So, understanding the first fact that if a traditional company is going ahead and doing the D2C market, it's obviously going to be a great offering for them as whole, because so far you've already tapped your market. You're available into maybe 100,000 of outlets. You're already you enjoy a great goodwill wherein you are offering a lot of products and services. Now we will go back and understand and try to have talk with your consumer. It's obviously going to be great for you guys, wherein it's going to give you a whole lot of idea and a lot of development programs in terms of understanding how your consumer feel about the product. Till now, you were not able to get in touch with your consumers about maybe a small feedback or whatsoever it is. But with D2C, you can get that. With D2C, you can also understand all the kind of geographical locations that people are trying to buy your product from, the right kind of age group, maybe what is the correct kind of cart value and all of it. So it's going to be a lot of value added services for a traditional FMCG company going and adopting D2C as a go-to-market strategy, wherein again for D2C to traditional offline markets, it's going to take a lot of efforts for them. First, because they have seen the easy side of it, of developing their consumer base. This is going to be the hard side of it. On day-to-day basis, you have your marketplace orders and you have your website orders and all of it. But now when you get into that traditional business, primarily your goods go to distributor, then your goods go to retailer, and you're going to wait when an end consumer is going to come and buy, wherein here your charts are taking up high every day, and there at the end of the month, if you just take and sit on your balance sheet, you'll see that the goods are lying on the shelf, but it's not directly reached out to the consumers well. Other thing which I feel it's going to be a pain point for D2C brands to go offline or maybe do a traditional way of businesses. They do give a lot of discounting, a lot of other offers running around, because that's how you attract your consumer when we speak of D2C, which is practically not possible when we go in that traditional sort of market. Right now, if I'm selling my product on 25-30% off on Amazon, I cannot do the same offline, because if I do it, there is not correct measure to monitor unless you write it on pack that this 100 rupee product is now been given at 75, which is practically going to devalue your brand. So you're not going to do that. You'll have to rely on your retailer, assuming that he's going to pass away the discounts. So which is again going to be a pain point to balance their product offering at the same cost online and offline, which have been, I think, fight between the actual retailer market and the e-com industry. Because e-commerce, it is very easy to pass on the discounts. There are no such systems. Like not complex systems wherein commercial systems are very complex when we speak of traditional FMCG businesses. So it is going to be little tough for them. So my advice to D2C companies who's getting into offline channels would be making sure that do not only rely on discounts. That's not how you build your consumer base. Make sure that brand is super solid. Until and unless you do not work on the branding aspect of it, just selling the product is not going to take you anywhere. Say for instance, any other brands are doing great volumes these days, but that is not the end of it. Right now, yes, you're trying to understand and maybe tap the consumer, but once you stop giving that offering or discounts, your sales going to go half. So try and build a strong brand rather than just pushing on discounts is what I'll feel.
Mangalam, what's the word on the street? What are the market's opinions on FMCG versus D2C and any instances that you see of this coming up in earnings calls?
It has happened. In fact, as we speak, I was preparing for that. I was looking at, the kind of acquisitions that traditional FMCG companies have made of D2C brands. And what really stands out is that this new business versus old business sort of story. In this, what happens is that you've seen Grow go ahead and acquire Indiabulls Housing Finance. You've seen Fmcg go ahead and acquire Thyrocare. That's the non-consumer space. But in the consumer space, it's usually been Goliaths who've gone ahead and acquired David. So I would bet on the larger FMCG companies to go ahead and use the might of the cash and the distribution that reach that they have to acquire D2C brands who are struggling with scale. Because the market that India is right now, with the kind of growth that we're seeing in e-commerce, etc., we're still a largely mom and pop led, market. 90% of the sales still happen through traditional channels. So to that extent, D2C is a lot more visible and spoken of than the sales have to show for it. Just looking at the way D2C has been, from a large FMCG standpoint, Marico acquired Just Herbs, it's acquired Beardo, you've had Imami acquire the Man Company, they've acquired True Native, ITC has gone ahead and acquired a couple of baby care companies, Kavin Care itself has gone ahead and acquired a handful of companies, HUL, the biggest of them all, has acquired VWash too. So the larger companies will eventually look at acquiring brands which are struggling. The only question is the kind of valuation that they pay for it. Talking about earnings calls itself, Marico has said that they expect about 100 crore in terms of revenues from Beardo this year. And over the next couple of years, they would have a portfolio of 450 to 500 crore worth revenues coming in from just digital first brands. So the truth is not FMCG versus D2C. The truth lies somewhere in the middle. It's FMCG and D2C put together.
Let's look at the same thing from an investment angle, right? What factors should one keep in mind when thinking of investing in the FMCG space and D2C space?
Investing in the FMCG space, you just have to look at one thing, the valuations at which you're getting, the size of the opportunity, and the company's prospects in that overall scheme of things. You buy a leader, you buy number two who's growing fast. Have any of the fundamentals changed? And over the last few years, what we've seen is the easiest thing to bet on in an FMCG company is if there is a leadership change. We've seen that with Pratik Pota entering Jubilant Food, leaving Jubilant Food as well thereafter. You've had a couple of new, Varun Berry joining Britannia, Sudhir Sidapati joining Godrej Consumer. So a management change is an important thing you have to watch out for in the FMCG space. And in D2C itself, we've seen a lot of these new age companies list on our bourses. I would suggest just look at two things. One is the consumer acquisition cost, which is known as the CAC. And the second is the consumer lifetime value, which is the revenue that the consumer brings to the company over a period of his or her lifetime association with the company. So long as your consumer lifetime value is above the consumer acquisition cost or the cost that you pay to acquire that consumer, you're likely to be in the green. But the minute you're paying more to the consumer than the consumer is paying to you over their association with the company, then you're obviously always going to be, disadvantaged.
Yeah. There's the word out in the market that whenever you want to try and invest in D2C market, always invest in founder rather than investing into any other idea and all, which will make more sense because he's not going to let the company die. Obviously, things can go north or south, but investing in founder is one more thing.
Yeah. So, if you want to know more about the FMCG sector, do check out the FMCG Tracker Smallcase to understand the food and beverages, tobacco, household products, batteries and personal products companies, allowing investors to efficiently track and invest in the FMCG sector. Links in the episode description and show notes. On that valuable piece of advice, folks, that is a wrap on this episode of the Ideas Project. Priyank, thank you so much for joining us. Mangalam, thank you so much for joining us.
Thank you.
And folks, hope you enjoyed this fascinating talk with Priyank Shah and Mangalam Maloo as much as I did. If you liked this episode, do consider subscribing to the podcast and leaving us a review on Apple Podcasts and Google Podcasts. This podcast is powered by Smallcase. We will come back with more insightful conversations to help you achieve a well-rounded investment portfolio. Until then, bye-bye. See you on the next brand new episode of The Ideas Project.
Hello. It's been another great week on the IVM Podcasts Network. On Misconduct, Raghavi and Nisha celebrate the first anniversary of the podcast by looking back at Season 2. They are also joined by 3 special fans who recount their favorite episodes. On Cyrus Says Cock and Bull, Cyrus, Ayushi, Amit and Antariksh discuss how a man delivers his resume in a pastry box to the Bangalore startups. On The Wire Talks, Siddharth talks to French political scientist Christophe Jaffrelot about authoritarian regimes. On Ikka Dukka Economy, Abhinav asks renowned cybersecurity expert Dr. Pawan Duggal about possible cyber and financial dangers. And on The Longest Constitution, Priya talks about the freedom of expression with regards to nota or none of the above in EVMs or electronic voting machines. Do not forget, IVM Podcast has just launched its merch and the first line is out now. Head to the IVM Podcast website, click on the shop tab to check out our first collection of t-shirts. Do follow us on social media. We are IVM Podcasts on Twitter, Facebook, Instagram and LinkedIn. And remember, if you're enjoying this show or any of our other shows for that matter, please do tell a friend. Also, don't forget to rate us on any platform you're listening to. You can also check us out on YouTube. We're also doing a small listener survey to better understand how you respond to our shows and advertising on the network. We would really appreciate it if you could spare a few minutes to fill it. It helps us build better shows for you. And finally, we would like to thank our sponsors this week: Boat Lifestyle, Smallcase, Cap Gemini, Intel vPro, and Intel. Future Banao Wonderful with Intel-powered laptops.
There's a quick survey to fill out on ivmpodcast.com/survey. It lets us know a little bit more about who's listening to us. And you know what? We're going to do a few prizes. So, we'll do a random drawing of maybe 10 people and we'll send you all some swag. Remember, that's ivmpodcast.com/survey where you can fill out the survey.